Disclaimer.
You probably heard silver broke through some old resistance level during the holidays. Maybe you saw the headlines, scrolled past them while checking your phone between family dinners. Here's what you didn't hear. This was on a breakout, in the way breakouts usually work. There was no build-up, no media drumbeat, no talking heads preparing you for the move. Silver didn't ask permission. It didn't wait for confirmation. It simply shattered a ceiling that had held for 40 years while most of America was looking the other way. And the people who understand what that means are positioning right now. December 29th fell right in the middle of what traders call Ghost Week, that strange period between Christmas and New Year's when Wall Street empties out and trading volume drops to a whisper. Most professional traders take vacation days. Retail investors check their portfolios maybe once while scrolling between family gatherings. It's the financial equivalent of sneaking cookies from the jar when nobody's watching. But this year, during this exact window when everyone was distracted, silver did something it hasn't done since 1980. Silver hit $83.75 per ounce. Now, if you're not a precious metals follower, that number might not immediately register as significant. Let me put this in perspective for you. Back in 1980, the Hunt brothers attempted to corner the silver market, driving prices to an all-time high of $49.80. That price stood as an impenetrable ceiling for 40 years. Every rally, every bull market, every surge in silver would eventually crash against that historical barrier, like waves against a seawall. Until December 29th, 2025, silver didn't just edge past this legendary resistance level. It obliterated the ceiling in a single trading day, blowing through 40 years of history with the kind of momentum that makes institutional traders sit up and pay very close attention. But here's where this story gets really interesting, because what happened next tells us something critical about whether this move is real or just another speculative bubble waiting to pop. The COMEX, which is the major exchange where silver futures trade in our country, did exactly what you'd expect them to do when prices surged dramatically. They raised margin requirements twice, within 4 days. Think of margin requirements as the deposit you need to control a futures contract. When exchanges raise margins, they're making it more expensive to hold positions, which historically kills speculative rallies dead in their tracks. The margin went from $22,000 per contract to $32,500, a 48% increase designed to cool off overheated markets. Here's what should happen when margins spike like that. Speculators who are leveraged get squeezed out, selling pressure increases, and prices collapse back down. That's the playbook from every previous silver spike. But look at what actually happened this time. Silver barely flinched. After hitting that 83.75 peak, the metal pulled back but held well above the old 49.80 resistance. As I'm speaking to you today, silver is trading in the 70s, which means the 40-year ceiling has now become the floor. When margin hikes can't kill a rally, that tells professional traders something crucial. This isn't speculation driven like past cycles. There's real structural demand underneath this move. Now, let me show you the second piece of evidence that suggests something fundamental has shifted in silver markets. There's a metric called the gold to silver ratio, and it is exactly what it sounds like. How many ounces of silver does it take to buy 1 ounce of gold? This ratio has massive implications for both metals because it reveals which one is relatively cheap or expensive compared to the other. At the beginning of 2025, you needed 100 ounces of silver to buy a single ounce of gold. That's an extremely high ratio, suggesting silver was deeply undervalued relative to its precious metal cousin. But as we move through the year, and especially during this recent surge, something remarkable happened. The ratio collapsed to 59-1. Think about what that means in practical terms. If you had bought silver when the ratio was at 100 and held it through this compression, your silver would have gained substantially more than gold on a percentage basis. According to the Silver Institute's most recent market analysis, this represents the fastest ratio compression we've seen in decades. Why does this compression matter for your portfolio? Because historically, when gold and silver both rally, but silver outperforms dramatically, it signals that industrial and investment demand for silver is overwhelming the market simultaneously. Gold moves on monetary concerns and safe haven buying. Silver moves on those same factors, plus something else, real-world consumption. And right now, both engines are firing. But wait, there's more happening beneath the surface that most investors aren't tracking. While prices surged and ratios compressed, the physical metal itself started disappearing from the trading hubs where dealers and banks typically store inventory. London vaults, which serve as one of the major global storage centers for precious metals, saw their silver holdings drain to levels we haven't seen in a decade. Meanwhile, on the other side of the world, Shanghai inventories hit their lowest levels since 2015. The metal that traders use to settle contracts and make deliveries is quietly vanishing from the system. This brings us to the most significant development that happened while you were celebrating the new year. China, which controls somewhere between 60 and 70% of global refined silver supply through its dominance in mining and processing, implemented sweeping new export restrictions, effective January 1st, 2026. These aren't minor policy adjustments. China now requires anyone exporting silver to have minimum capacity of 80 tons and obtain special government licenses. Let that sink in for a moment. The country that produces most of the world has refined silver just put their supply behind a licensing wall. According to the Bank for International Settlements, when a major commodity producer restricts exports while global inventories are declining, it creates what economists call a supply shock. We've seen this playbook before with rare earth elements and other strategic materials. China doesn't implement export controls casually. They do it when they want to prioritize domestic consumption, or when they recognize strategic value in controlling supply chains. This export restriction arrives at a particularly interesting moment in silver's supply-demand dynamics. For 5 consecutive years, our global silver market has run deficits, meaning we consume more silver annually than we mine. The cumulative deficit over those 5 years has reached 820 million ounces. That's not a typo. We've collectively drawn down 820 million ounces from existing stockpiles to meet demand that exceeded new production. Where does all this consumed silver go? About half goes into industrial applications that don't recycle the metal effectively. Solar panels, electronics, medical devices, batteries, water purification systems. Once silver gets embedded into these products, it's economically impractical to recover. It's gone from the available supply pool, unlike investment silver that sits in vaults and could theoretically come back to market. So let's connect these dots for a moment. During the quietest trading week of the year, silver broke through a 4-decade resistance level and held above it despite aggressive margin hikes. The gold to silver ratio compressed faster than it has in decades, while physical inventories drained from major trading hubs. And just as this was unfolding, the country controlling most of the world's refined supply threw up export barriers. If you were designing a setup for explosive price discovery in a commodity market, you'd be hard-pressed to create better conditions than what we're seeing right now in silver. The question you should be asking yourself isn't whether this breakout matters. The question is whether you're positioned for what comes next, or whether you will be one of the investors who realizes 6 months from now that they missed the setup while they were distracted during Ghost Week. Because here's the reality. The smart money didn't miss it. They were watching. And they're moving. Every financial commentator with a keyboard is telling you the same story right now. Silver's too hot. The rally's extended. Margin hikes will kill the momentum. Volatility means it's time to take profits and step aside. You've heard this narrative before because it's the safe play for people who need to sound smart without sticking their necks out. But what if I told you that everything being sold as a warning sign is actually confirming that something much bigger is unfolding? Let's start with those margin hikes that supposedly prove silver's rally is about to collapse. Between December 26th and December 30th, COMEX raised margin requirements from $22,000 per contract to $32,500. That's a 48% increase in less than a week. Exchanges don't do this casually. They implement margin hikes specifically to cool off markets they view as overheated and to protect themselves from default risk when traders get overleveraged. Here's what every trader knows about margin hikes. They work. When you suddenly need 48% more capital to maintain the same position, leveraged speculators get forced out. They don't have a choice. Either they deposit more money immediately, or their positions get liquidated automatically. This creates a cascade of selling that typically crushes whatever rally was in progress. We saw this exact playbook work in 2011 when silver hit $49. Margins went up, speculators got flushed out, and silver crashed back to the 20s within weeks. So the question isn't whether margin hikes should have worked. The question is why they didn't work this time. Silver pulled back from that 83.75 peak, sure, but look at where it stabilized. We're still trading in the 70s, which means silver is holding more than $20 above that supposedly impenetrable 49.80 ceiling from 1980. When margin hikes fail to break a market back below major resistance, it tells you something critical about the underlying structure of that move. Think about what has to be true for a market to shrug off a 48% margin increase. It means the buyers aren't primarily leveraged speculators chasing momentum. It means there's demand coming from participants who don't care about short-term volatility because they're accumulating physical metal for reasons that have nothing to do with trading around price swings. According to Federal Reserve data on commodity futures positioning, when margins rise sharply but prices stabilize quickly, it indicates the presence of commercial hedgers and physical market participants whose buying is structural rather than speculative. This brings us to the second so-called red flag that is actually flashing green when you understand what it means. Bank of America, one of the largest financial institutions in our country, released updated silver price targets that should have made headlines everywhere. They're now projecting silver could reach between $135 and $309 per ounce. Read that again. A major Wall Street bank is putting their name on a forecast that has silver potentially rising another 300% from current levels. Now, you might be thinking that banks publish optimistic forecasts all the time to generate trading commissions or position their own books. Fair point. But here's what matters more than the forecast itself. What institutional money is actually doing with their capital. Because talk is cheap, but moving nine-figure sums into physical metal speaks volumes about conviction. In Utah, institutional investors placed orders exceeding $100 million for physical silver. Not futures contracts, not ETFs, not paper derivatives, physical metal that gets delivered and stored. When you're moving that kind of money into an asset, you're not day trading. You're not trying to flip it for a quick profit. You're building a position because you believe the fundamental supply-demand dynamics are about to shift dramatically in your favor, and you want exposure before the broader market figures it out. Pop quiz: if you were an institutional investor with $100 million to deploy, would you put it into one of the most volatile commodities on the planet during a period when everyone's screaming that the rally is overextended? Only if you had access to research and analysis that gave you confidence, the volatility was noise, and the underlying trend was just getting started. These aren't retail investors panic buying on Reddit. These are sophisticated money managers who answer to pension funds and endowments and family offices. They don't bet nine figures on hunches. The institutional buying shows up in another place that most retail investors do not track: silver ETF flows. Exchange-traded funds that hold physical silver saw inflows of 200 million ounces in 2025. To put that in perspective, analysts at the beginning of the year were forecasting ETF inflows of maybe 70 million ounces. The actual number came in nearly 3 times higher than expectations. When institutional money surprises to the upside by that magnitude, it means demand exceeded what even the professionals anticipated. But let's dig into the third piece of evidence that volatility and high prices are confirming strength rather than signaling danger. There's an obscure metric called silver lease rates that reveals something fascinating about the physical market. When you own silver bars sitting in a vault, you can lend them out to industrial users or traders who need physical metal for short periods. In normal markets, silver lease rates hover near zero because there's plenty of available metal and owners are happy to earn even small returns on assets that otherwise just sit there. Silver lease rates spiked above 5% 5 separate times during 2025. Think about what that number represents. Someone who needs physical silver right now is willing to pay 5% annualized just to borrow it for a short period. That's not a sign of abundant supply. That's a sign of tightness in the physical market where holders of metal can demand serious premiums because borrowers are desperate to secure supply. According to the London Bullion Market Association, which tracks these metrics across global precious metals markets, lease rates spiking above 5% historically correlates with periods when physical inventories are strained and industrial users are competing aggressively for available supply. This isn't media hype or speculation. This is measurable scarcity showing up in the price people pay to access metal that normally trades at negligible borrowing costs. Here's where these 3 data points converge into a single narrative that contradicts everything the bearish commentators are selling. Margin hikes failed to kill the rally, suggesting structural demand overwhelms paper market manipulation. Institutional money is accumulating during the exact volatility that scares retail investors away, suggesting sophisticated participants see opportunity where others see risk. And lease rates are spiking repeatedly, suggesting physical tightness is not some distant future scenario, but a present reality showing up in daily market mechanics. Now, let me show you why the obvious concern about high prices is actually another bullish signal when you look at historical precedent. People see silver trading in the 70s and immediately assume it's expensive, that we're due for a correction, that the smart play is waiting for a pullback. But expensive compared to what? If you adjust silver's 1980 peak of $49.80 for inflation using the standard consumer price index, that peak would be roughly $150 in today's money. We're not even halfway to the inflation-adjusted high. But here's where it gets even more interesting. The CPI arguably understates real monetary inflation because it doesn't fully capture asset price inflation or the expansion of the money supply. Our M2 money supply, which is the broadest measure of dollars circulating in the economy, was roughly $15 trillion in 2020. Today, it stands at $22.4 trillion. That's a 49% increase in the money supply in just 5 years. If you adjust silver's historical peaks for actual monetary expansion rather than just consumer price inflation, current prices look remarkably cheap, not expensive. Think about this from a different angle. When gold was trading at $400 per ounce in the early 2000s, people said it was expensive. When it hit $800, people said it was a bubble. When it crossed 1,500, people said it couldn't possibly go higher. Gold is now above $3,000, and major institutions are forecasting $5,000. At every step, the consensus viewed higher prices as proof that the rally was over, when in reality they were just waypoints in a longer trend driven by monetary debasement and supply constraints. Silver follows a similar pattern, but with more explosive volatility because the market is smaller and tighter. When silver moves, it doesn't climb steadily. It lurches in violent bursts that shake out anyone without conviction. The people who make money in silver aren't the ones who sell every time prices spike. They're the ones who understand that volatility is the entry fee for asymmetric returns, and they use the fear created by that volatility to accumulate when others are panicking. Let me give you a concrete scenario to make this tangible. Imagine you're managing money for a sovereign wealth fund or a major pension system. You see the same data we've just covered: margin hikes failing, physical inventories draining, lease rates spiking, China restricting exports, 5 consecutive years of deficits. Your mandate is to preserve purchasing power over decades, not trade around quarterly volatility. Do you wait for a pullback that might never come? Or do you start building a position even though financial media is screaming that silver's extended? The institutional orders in Utah, the ETF inflows that tripled expectations, the Bank of America price targets, these aren't accidents or coincidences. They're the visible evidence of smart money answering that question by accumulating during the exact period when retail investors are being told to wait on the sidelines. And here's the uncomfortable truth. When institutional money and retail investors are moving in opposite directions, history suggests betting with the institutions tends to work out better over time. The final piece of this puzzle involves understanding what happens when physical markets decouple from paper markets. For years, the silver price was largely determined by futures trading on COMEX, where the vast majority of contracts settle in cash rather than physical delivery. This created a situation where paper supply could overwhelm physical demand, keeping prices suppressed even as industrial consumption exceeded mine production. But when physical inventories get tight enough, something shifts. Buyers who actually need the metal for industrial use or investment storage start demanding delivery rather than accepting cash settlement. This forces the paper market to reflect physical reality, and that's when you see the explosive moves that catch everyone by surprise. The margin hikes failing to crash prices suggests we may be entering this decoupling phase, where paper market tools no longer control physical market dynamics. So, when you hear commentators warning about red flags and overextended rallies, ask yourself what they're actually measuring. Are they looking at COMEX futures positioning and technical indicators, or are they tracking physical inventories and institutional money flow? Because those two views of the market can tell completely opposite stories. And right now, the physical market is screaming something the paper market hasn't fully priced in yet. The question isn't whether silver is expensive at current prices. The question is, what happens when the broader market realizes the setup we just walked through? Let's talk about numbers. Not the kind of vague predictions that financial commentators throw around to generate clicks, but actual mathematical relationships that exist, whether anyone believes them or not. Because here's what most investors miss: silver's price isn't random. It moves within mathematical frameworks that have held true across decades, and when those frameworks get stretched to extremes, they eventually snap back with force that surprises everyone who wasn't paying attention. Start with the gold to silver ratio, which we touched on earlier, but now needs to become the centerpiece of our analysis. This ratio currently sits around 59 to 1, meaning you need 59 ounces of silver to buy 1 ounce of gold. That's already a significant compression from the 100 to 1 ratio we saw at the beginning of 2025. But here's what should grab your attention. During precious metals, bull markets throughout history, that ratio doesn't stop at 60 or 50. It compresses much further. According to data compiled by the World Gold Council covering precious metals cycles since 1970, the average gold to silver ratio during bull market peaks hits around 40 to 1. Not the extreme 20 to 1 we saw briefly in 2011, or the 15 to 1 ratios that occurred in the late 1800s when silver was still monetary metal. Just the average 40 to 1 that represents a normal bull market relationship between these two metals. Now, let's run the math on what that means for silver prices if gold continues its own rally. Bank of America's research division recently published price targets forecasting gold could reach $5,000 per ounce. That's not some fringe prediction from a precious metals newsletter. That's a major Wall Street institution putting their reputation behind a specific number. If gold reaches $5,000 and the gold to silver ratio normalizes to that 40 to 1 average, you get silver at $125 per ounce through simple division. But wait, because that calculation actually understates what happens when you account for monetary expansion. Remember that M2 money supply figure we mentioned earlier? Our money supply grew from $15 trillion in 2020 to $22.4 trillion today. The 49% increase in the amount of dollars circulating through our economy means each dollar inherently purchases less than it did 5 years ago. Even if consumer prices haven't fully reflected that expansion yet, here's where the math gets really interesting. If you take silver's all-time nominal high of $49.80 from January 1980 and adjust it for the growth in M2 money supply rather than just consumer price inflation, that peak would equal roughly $830 in today's monetary terms. Current silver prices around $70 means we're trading at 11.8 times below the inflation-adjusted peak when measured against actual monetary expansion. Let that sink in for a moment. We'd need silver to rise another 11-fold just to match where it traded relative to the money supply 45 years ago. Now, I'm not suggesting silver is heading to $800 tomorrow. What I'm showing you is that claims about silver being expensive or overextended at current prices fundamentally misunderstand the relationship between commodity prices and monetary debasement. When measured against the expansion of our money supply, silver remains deeply undervalued compared to its historical peaks, which means there is substantial room for upside before you could legitimately argue the metal has gotten ahead of itself. Let's shift to the supply side arithmetic, because this is where the math becomes unavoidable, regardless of what anyone believes about monetary policy or inflation. The Silver Institute projects our global silver market will run a deficit of 30.5 million ounces in 2026. That means worldwide, we're going to consume 30.5 million more ounces than we mine. This continues a pattern that's now stretched across 5 consecutive years, with cumulative deficits reaching 820 million ounces. Think about what 820 million ounces represents in practical terms. Global annual mine production sits around 835 million ounces as of 2025. So over the past 5 years, we've drawn down nearly a full year's worth of mine production from existing stockpiles just to meet demand that exceeded new supply. Those stockpiles don't replenish themselves. Every ounce pulled from inventory to fill the gap between consumption and production is an ounce that's no longer available for the next buyer who shows up needing metal. Here's where the supply situation gets even more constrained. Silver mine production peaked back in 2016 at 900 million ounces and has been declining since, falling to 835 million ounces last year. This isn't a temporary dip that resolves with higher prices. About 75% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. When you're mining copper and you get silver as a secondary output, rising silver prices don't make you suddenly mine more copper. The economics of your operation are driven by the primary metal, not the byproduct. This creates a supply response problem that's unique to silver. When oil prices spike, producers can drill more wells and bring new production online within months or a few years. When silver prices spike, most of the supply comes from operations that exist to mine other metals, so there's no quick mechanism to increase production even when the economics would justify it. The small percentage of primary silver mines can't scale fast enough to offset deficits measured in hundreds of millions of ounces. Let me give you a concrete scenario to illustrate why this matters right now. We're heading into February through April 2026, which represents one of the most critical windows for silver demand in the annual cycle. India, which is one of the world's largest silver consumers, sees massive seasonal demand during this period for jewelry, religious items, and weddings. This happens every year like clockwork. Indian buyers show up in the physical market and absorb enormous quantities of metal. Simultaneously, we're entering the first quarter ramp for solar panel manufacturing. Solar applications consumed over 140 million ounces of silver in 2025, according to industry data, and that number keeps growing as solar installations accelerate globally. Manufacturing ramps up in Q1 to meet installation demand later in the year, which means industrial buyers are competing aggressively for available supply during the exact same window when Indian seasonal demand peaks. Now add the China export situation into this mix. Those new restrictions requiring 80-ton minimum capacity and government licenses went into effect January 1st. The licensing process isn't instantaneous. Companies need to apply, wait for approval, arrange logistics, and actually move metal across borders in compliance with the new regulations. This creates inevitable delays in supply chains that were already stretched thin, and those delays hit during February through April when demand is seasonally strongest. What happens when seasonal demand spikes? Industrial consumption ramps up, and supply chains are disrupted by regulatory changes, all while inventories sit at decade lows and the market is running the 6th consecutive annual deficit. You get what economists call a supply shock. Buyers who need physical metal find themselves competing for shrinking available supply, and that competition shows up as price discovery that moves much faster than anyone anticipated. History provides a useful guide here. When gold to silver ratios compress during bull markets, they don't move in orderly linear fashion over years. They compress in explosive bursts that happen over weeks or months. In 2011, silver went from $30 to $49 in less than 3 months, as the ratio squeezed from 46 to 32. In the late 1970s, silver went from $6 to $50 in less than a year as the ratio compressed from 40 to 8. The pattern repeats because of how markets work when supply is physically constrained. In normal markets with elastic supply, price increases bring more supply to market, which stabilizes prices at the new level. But in markets where supply is inelastic, meaning higher prices can't generate more supply quickly, you get price spikes that overshoot fundamentals before eventually settling back down. Silver combines inelastic supply with relatively small market size compared to gold, which creates the explosive volatility that makes people rich if they're positioned correctly and destroys accounts if they're on the wrong side. Here's the uncomfortable question you need to ask yourself. What's your plan if this math plays out over the next 6 months instead of the next 6 years? If the gold to silver ratio compresses to 40 and gold reaches even $4,000, not Bank of America, is 5,000 target, just 4,000, you get silver at $100. If lease rates keep spiking and inventories keep draining, and Chinese export licenses create supply bottlenecks during seasonal demand peaks, how fast could that $100 target get hit? The institutional money we discussed earlier is answering this question by accumulating now, rather than waiting for perfect entry points that might never materialize. They understand that in compressed time frames, trying to time bottoms is a fool's errand. What matters is having exposure before the broader market recognizes the setup, because once recognition happens, the entry prices vanish within days or weeks. Let me be very clear about something. I'm not telling you silver can't pull back from current levels. Markets don't move in straight lines, and silver is notorious for violent shakeouts that test the conviction of everyone holding positions. What I'm telling you is that the mathematical relationships we've walked through, ratio normalization, supply deficits, monetary expansion, create a framework where significantly higher prices aren't just possible, but probable over the time frame we're discussing. Risk management matters here more than ever. If you're going to participate in a market that can drop 15% in a day and rise 20% the next week, you need to size your positions appropriately and think in terms of core holdings rather than trading around every wiggle. The people who make money in silver aren't the ones with perfect timing. They're the ones who survive the volatility long enough to capture the moves that matter. So where does this leave us? We started by showing you how silver broke through 40 years of resistance during Ghost Week, while most investors were distracted. We revealed how the supposed red flags, margin hikes, volatility, high prices, are actually confirming structural demand and institutional accumulation. And now we've walked through the specific mathematical targets that make $150 look conservative rather than optimistic, based on historical relationships and current supply constraints. The critical window is approaching faster than most people realize. February through April 2026, Liu could force the kind of physical delivery crisis that makes current prices look like the opportunity everyone wished they'd recognized in hindsight. China's export restrictions, seasonal demand peaks, declining inventories, and 5 years of cumulative deficits are converging in a way that happens maybe once or twice per decade in commodity markets. You now know what the smart money knows. The question isn't whether this setup is real. The data speaks for itself. The question is whether you're positioned for what happens next, or whether you'll be watching from the sidelines when the math we just walked through starts playing out in real time. Because unlike Ghost Week, when this really accelerates, everyone will be watching. And by then, the entry prices we're seeing today will be the prices people wish they could get back.